Okay, let's go ahead and get started then. I'm Larry Wall. I've got a more grandiose title, but you can simply think of me as an economist who works at the Federal Reserve Bank here in Atlanta. And let me emphasize the standard disclaimer, since this is not the standard academic audience that I speak to. The views I'm going to express here are mine and mine alone, and don't necessarily represent the Federal Reserve Bank of Atlanta, the Federal Reserve System, anybody in the Fed. There are mine and mine alone. And let me do a very quick level setting. I think this is unnecessary, but just to be on the safe side. So I'm going to be talking about Bitcoin and cryptocurrencies versus government-issued currencies. And so for Bitcoin and cryptocurrency, I'm going to take that as a token issued on a blockchain, intended to serve as a substitute for government-issued currency in paying for goods and services. It's going to be on a permissionless read from and write to blockchain, censor resistant, and I think consistent with a strong philosophy of most people in this area, no reliance on a third party for execution. The current alternative is government issued currency. Here typically you'll have a central bank, the Federal Reserve, the European Central Bank, the Bank of England, issuing a limited amount of outside money. And then you'll have fractional reserve banks, say SunTrust is a local example, issuing liquid claims that serve as inside money. So you can think of like demand deposits, backed by some combination of central bank claims, bank reserves held at the Fed, securities such as government securities, and loans that they've made to individuals and corporations. One common feature of government-issued currency is that typically it's the only acceptable currency for payment of taxes. Now, this chart is from CoinMarket.cap, and I think it's a fairly familiar one to most of the people in this room. Cryptocurrency values soared in 2017, reaching a total market capitalization of around $829 billion. And this led many crypto advocates to argue we are on the dawn of a new era in which cryptocurrencies will soon replace government-issued currency, quite often referred to as fiat currency. Of course, what followed was not quite so pleasant if you were holding cryptocurrency, with a fairly sharp decline throughout 2018 and extending a little bit into this year. So the common response that I see when I'm reading the literature is to point to the Gartner hype circle in innovations, where innovations inevitably reach some peak of inflated expectations, then have to go through a trough of disappointment or disillusionment before they hit the slope of enlightenment and a plateau of productivity. But entering into the trough is not sufficient to guarantee that a new technology will ultimately enter that slope of enlightenment. So what would it take for cryptocurrency to become what some of its advocates want, a major part of the global financial system? So let me start first by, again, a little bit of a level setting. Let's see how big a task we have here. Crypto may have risen dramatically, but in global terms, it's still not even in the minor leagues. If crypto is going to replace government-issued money, it has a long ways to go. From CoinMarketCap on February 5th, the market capitalization of all cryptocurrencies was less than 150 billion. And if I look back on transactions volume, the 24-hour peak on transaction volume on CoinMarketCap was under 70 billion in early 2018. Let's compare that with the US dollar. And here I want to emphasize that is just the US dollar. We're not talking about the euro, we're not talking about the yen, we're not talking about including the Chinese renminbi, the UK pound, or any of a number of other government-backed currencies, government-issued currencies. The base amount of US dollar that's been issued, the currency in circulation is 1.7 trillion. Reserve balances that the banks are holding at the Fed is 1.6 billion. If we look at what the total money supply was seasonally adjusted on January 14th, M1, which is currency plus things like checking accounts, was at 3.8 trillion. If we throw in money market accounts it goes up to 14.5 billion. And to scale the transactions volume, I looked at one way of transacting, FedWire, which is the Federal Reserve's large dollar payment system. So this isn't checks, this isn't automated clearinghouse, this isn't Visa and MasterCard, it's just one way of paying in dollars. And that had an average daily transaction of almost 668,000 transactions for $2.8 trillion in transfers. So cryptocurrency, if it's going to make it, has got a long ways to go. But what would it take for cryptocurrency to become a major part of the global financial system? The first part of this presentation is going to focus on a few of the necessary conditions for crypto to have any chance of joining the big leagues. And understand these are necessary conditions. They have to be satisfied. They're not sufficient conditions. It's not like if you satisfy these, it's a sure thing. And the last part is going to focus on the likely emergence of fractional reserve banking in cryptocurrency. An issue which I don't think has yet been taken seriously enough in the crypto community. So some necessary conditions for crypto to become a big league, and I'm going to talk about 3 issues, starting with some valuation issues, then we'll talk a little bit about consensus methods, and then we'll talk about governance. So among the current issues, a very common argument you hear both sides of is cryptocurrency has no intrinsic value, to which the usual retort is well, there's really nothing backing government-issued currencies either, so what's the difference? To which you'll get a few people on the government-issued side say, but government-issued can be used for taxes, and there's nothing that cryptocurrency has to be used for. Rather than rehash kind of those debates about which I have nothing new to add, I think we can just simply agree the value of a currency is whatever people are willing to trade it for. What is a bit different about cryptocurrency is it doesn't yet have an anchor to its value, something that will keep it above zero, unlike commodity money, where the money could be used as commodity or as government issued, where it could be used for paying taxes. And so whether it will ever get that anchor remains to be seen. But the result now is that cryptocurrencies have a very volatile value that limits its usefulness as a means of payment. Most people have to pay at least some fraction of their bills in a government-issued currency, and they need to have some good sense of what sort of revenue they're going to have and in that government-issued currency, and that's just not possible now. In part, this is because a large fraction of the current trades are by investors and speculators, where price is set based on expectations of future value, and expectations of future value can vary quite widely through time. To a much smaller extent, and this is mostly true of the smaller currencies, but there's a paper by a group of professors at the University of Florida presented actually on Friday at another GSU finance conference, where they were quoted, where they say that there are pervasive pump and dump schemes that increase the volatility for many cryptocurrencies. Second issue with valuation is the supply of new cryptocurrencies, the potential for them always to be created, another one to be created. Now there's the naive version that says there's no limit to the supply of cryptocurrencies because there can always be another one created. Yeah, that's true. Like, I could go out and create a new cryptocurrency, and probably all of you would get a good laugh out of it and promptly ignore it. And in terms of adding to the supply of cryptocurrencies, it would mean nothing. The better version of this, though, is that there's potential for a new crypto with superior characteristics to replace an older crypto, driving its value to zero. Now you can tell me, yeah, Larry, that's theoretically possible, but come on. Bitcoin, for example, is very well established, and it has this network effect, and lots of people are interested in it. It's not going away. Maybe yes, maybe no. But to the extent you believe that network effects are going to save these things, my response is going to be, yeah, but the network effects for older cryptocurrencies is trivial compared with the network effect benefiting government-issued currencies at this stage. So let's turn to the next issue, some concerns about consensus methods. So the public permissionless read-write blockchains must have a cost of attacking that exceeds the benefits of attacking, otherwise they're just not going to be viable. Bitcoin, as you all know, I'm sure, uses proof of work, which is necessarily energy intensive. It needs to be, because you need the cost of attack to exceed that potential benefit. But that comes with a whole bunch of costs of its own, including some environmental costs. It also has proven difficult to scale on-chain, but it's not at all obvious that while Bitcoin has not yet been successfully attacked, that doesn't mean it can't be or wouldn't be. There's a paper from Eric Budish at the University of Chicago where he just basically did some simple math and said the reason Bitcoin hasn't been attacked is because you can't do large value transactions on Bitcoin. And when that changes and you can maximum transaction sizes that are feasible jump from a few tens of thousands or less to hundreds of thousands or millions, all of a sudden the economics start to change. And attack becomes much more feasible. On top of that, there's a very recent paper from the Bank for International Settlements that says, okay, Budish was talking about the gains from attacking, and they agree with that, but they say there's this other problem, that right now, the way in which miners get compensated is that new Bitcoins are created. So in addition to whatever fees the people wanting a transaction pay, the miners get new Bitcoins. But that's going to go away since there's a cap on the number of Bitcoins. And at that point, you're going to run into a problem. As for any individual Bitcoin user, my incentive is to minimize the fees that I pay because I'm paying them. But in aggregate, I need for the fees to be large enough so that it's not worthwhile attacking the chain. And they raise the question of, how is this going to work? And will the fees be sufficient to do it? And so when I look at this, I see, well, it's going to be really hard how a cryptocurrency based on proof of work can achieve both the scale to be a significant factor without simultaneously creating more than sufficient incentives to attack it. And I'd add that to the extent you're going to have a blockchain as critically underlying an economy, it's not just, is there an economic gain? By one estimate that I've seen, governments around the world spend $1.7 trillion on military spending. For some governments, attacking a blockchain that is central to another country's economy as an alternative to a military attack would not only be a financial bargain, but they could get the potential win without bloodshed. So, and we're certainly seeing attacks from around the world, especially North Korea, but other places as well, on the financial system as matters stand now. So there certainly are alternatives under development, e.g. proof of stake that Ethereum is talking about going to and is planning on going to. Will these deter attack in a high-stakes environment without relying on a trusted third party? Yet to be proven. Maybe yes, maybe no. This is not I didn't come to you with a set of impossibility conditions, only a set of necessary conditions. But certainly there are many in the cryptocurrency community who would say these alternative consensus methods are much less secure than Bitcoin. Another question is how do we get from here to there? Is it that new cryptocurrencies are going to replace the existing cryptocurrencies with the result that ultimately Bitcoin has zero value? Or are the existing currencies going to adopt new technologies? And to the extent you think it'll be because they're going to adopt new technologies, such as Ethereum adopting proof of stake, this leads into my next topic, which is blockchain governance. The blockchain must permit technical changes to the code for bug fixes and potentially to adjust for the technical changes in the technical environment, the way the internet works and computers and various things. There's some debate whether non-technical changes should even be permitted, I guess. Changes that aren't merely technical in nature can also change the operation of the blockchain in ways that disadvantage users. But as we were just talking about, non-technical changes may be needed to keep up with the external environment and to create new opportunities. And so I reference a recent Medium article by Vladimir addressing this issue. But the potential for any change means the potential for radical change. That includes the potential to drop part of an existing blockchain. meaning the blockchain is not immutable. And indeed, both Bitcoin and Ethereum have had forks that have dropped part of the prior blockchain. With Ethereum, it was the famous DAO example, but one that I had not known about until fairly recently, for Bitcoin, in August 2010, a hacker used a value overflow to generate over 180 billion Bitcoin. Satoshi Nakamoto forked the blockchain to remove those extra Bitcoins. Otherwise, the article I was reading in Hacker Noon was saying Bitcoin might not have survived to this day. And similarly, if a blockchain is running smart contracts, their operations could change. And if you have a new consensus method that's adopted that's faster but less secure, if I have a long-running smart contract on that, I might be concerned. So who gets to decide what changes are written into the code? If it's a small group, are they de facto the trusted third party? If anyone can propose new code, will anyone filter the proposals to determine which ones are considered? And trust me, if blockchain becomes seriously important and you have lots of players with big money at stake in this, they're each going to be trying to write up the code and sell their version of how it ought to operate. And so, along with potentially some small players. Will there be any quality control? Could I make a proposal that would probably be completely bug-ridden? Will there be any consistency with the long-run vision of where the blockchain wants to go? If yes, if there is somebody that's filtering the proposals, are they de facto a trusted third party? And then finally, who decides whether the changes are adopted? Well, whatever your answer to each of these, will these people take adequate account of the interest of all the stakeholders? And here I kind of like to compare it with corporations. The shareholders of a private corporation are the residual claimants. That is, they have an incentive to maximize the difference between the revenue that they earn and the costs that they bear. So to pick the highest value products and produce them in the cheapest way. And in that sense, they take account of the full value that is being produced. Blockchain doesn't produce anything like this, and so there's nothing comparable. There's no comparable party in the blockchain. Again, this is not news. This is work that is being looked at within the blockchain community, and there certainly are efforts underway to address this. Question again, will they prove adequate? And the answer is, we will find out in time. Now, one common response to, well, all these bad governance things can happen is, well, there's this threat of forking. If somebody comes in, does something bad, then the rest of that blockchain community can just fork away and keep going. Okay, that threat's credible so long as a cryptocurrency remains a trivial part of a global financial system. People are concerned, and rightly so, that there's going to be some reduced network effects, but that's actually part of the deterrent value of forking. But forking's not going to be so acceptable for cryptocurrency that is an important part of the financial system. Right now in the financial system, an essential part of it is I make promises now that I will pay you at some date certain in the future a certain amount. And if it's my mortgage, some of those days are quite a ways down the road, many years down the road. And if I may be buying some other goods and services. When a blockchain splits, which cryptocurrency is used to settle the promise? If you're going to have something that's seriously running the financial system, you don't get to have 2 or 3 different cryptocurrencies. The problem becomes even worse if the blockchain is used to record claims on real physical assets. And here you might think of Szabo, the guy who was started the smart contracts, gave the example of, I'll take out a loan on my car, and the blockchain will know whether or not I paid the loan on a timely basis, and if I don't, the car will stop. I don't know about you, but I'm not too keen on the idea that there might be 2 or 3 or 4 blockchains, any one of which could stop my car. And so forking, once you get into the big leagues, forking really isn't possible. Again, as I said, there are people these are not new issues to the community, and there certainly are people that are working seriously on them. Whether those would work at scale remains an interesting question. So let me talk about, suppose it does succeed. Suppose some cryptocurrency becomes an important part of the financial system. So will banks have a role under cryptocurrency? Part of the argument for cryptocurrency being superior is the claim that it will eliminate the need for banks. We'll have, costless money transfers, and in terms of whatever lending is needed, we can do peer-to-peer lending. I don't find those arguments entirely convincing. Cryptocurrency can't be costless. There has to be that incentive not to attack it. The miners and forgers have to be compensated for their costs and have to find it more valuable not to do it. And second of all, if you look at the way peer-to-peer lending is working now, it's actually not peer-to-peer. The bulk of the funding is being provided by institutional investors. Somewhere in the chain has to bear the costs of evaluating, monitoring, and collecting on these loans. And if you actually look at the peer-to-peer lending, the bulk of it is, to the best of my knowledge, pretty much all of it, is unsecured lending, which avoids the problem of conflicts within the investor group, because if everybody in this room owned a fractional interest of a loan that went bad and we could claim their car, then immediately the question among us would arise, well, okay, so how are we going to sell this car? How quickly, how much money are we going to be looking for to redistribute back to us? And there's no guarantee that there's going to be any form of agreement. So would banks have a role then under cryptocurrency? Well, first let me re-explain what I mean by a fractional reserve bank. This is a bank that obtains funds from depositors and from their owners, the stockholders. There can be additional complications in the financing, additional things that they do, but this is your very basic bank. And then they, in turn, hold those funds in some sort of base currency, maybe paper currency in their vault, or reserves at the Federal Reserve if it's the U.S. They lend some of the money out to people like you and me and to corporations. And they may hold some of it in the form of securities, for example, government bonds. Now, this fractional reserve dates back to at least the Roman Empire, and it provided the advantages borrowers had access to loans, and part of the interest that gets paid on those loans goes to paying interest to depositors, either explicitly or implicitly in the form of providing lower cost services. And so banks became a trusted third party. And I know a trusted third party is almost verboten here, but the notion that the trusted third party is going to run off and do a bunch of stupid things and attack their own network is not a great idea, partly for legal reasons and the problems they can get, and partly because they're supervised, but partly also because to the extent a bank is profitable, they're foregoing those profits as soon as they start the attack. And their ability to exploit their position is also limited by competition. Now, I'm not here to claim that banks are perfect. Indeed, I've been studying the imperfections in banking for a long time. And for some of you, that means that I've been studying the problems in banking since before you were born, probably. But pointing out the flaws is much harder than coming up with a fundamentally different system that's going to work better. So I would argue that if a crypto becomes important, it's likely to have fractional reserve banks arising. I really don't see how the blockchain code could prevent this. Certainly if you're going to stick with the philosophy of permissionless, censor resistant, I don't see how the code could. Now, so the usual argument that I've seen, and maybe there's one that I've missed, is that depositors will demand 100% crypto backing for their deposits. I don't find that argument particularly persuasive. Depositors have long traded some additional risk of default loss for reduced exposure to theft, greater liquidity, and receipt of interest. And then when I look around the crypto world and I say, oh, this is a much different world, these people are going to be much more risk averse, I go, yeah, no, that's not what I'm seeing. A large fraction of cryptocurrencies are held in wallets where the wallet providers have been hacked for the equivalent of billions of dollars. And cryptocurrency users invested the equivalent of many billions of dollars in initial coin offerings. And some of these might well turn out to pan out, but some of them were barely disguised frauds, and others lacked a plausible technical and/or business plan from the very start and seemed pretty much doomed. So what is the implication of fractional reserve banking? Well, as I pointed out earlier when I talked about reserves at the banks versus M1 and M2, a large fraction of what is counted in the as US money supply is deposits at the Federal Reserve, or is deposits at fractional reserve banking. So fractional reserve banking expands the money supply beyond the base amount of currency. You know, you regularly hear Bitcoin, there's a maximum number of Bitcoin that can ever be issued, and so that's what's going to set the value. Well, if you have fractional reserve banking, you can have something that's very close to a Bitcoin. It's not exactly the same, just like dollars in your billfold are not exactly the same as deposits in a bank. But they're very close substitutes. Deposits in a well-run fractional reserve bank should easily be transferred. You can use them for payments. And sellers in the crypto world would likely accept deposit transfers just like they accept credit cards and debit cards now. And let me tell you, merchants don't really like to accept credit cards because they're going to get dinged for fees on that. They're going to lose like 3% off the top, but they reckon that making the sale and losing that 3% is a lot better than not making the sale. And I see no reason why the same wouldn't happen. Now, I don't mean to imply, oh, this means that there will be unlimited growth in the amount of cryptocurrency that's outstanding. That's not going to happen. Even a fractional reserve bank has to hold some fraction in the base money, in reserves at the Fed or in Bitcoin or whatever, because on any given day, there is a reasonable chance that people are going to come in and try to withdraw more than the new deposits are going to be worth, and you have to be prepared for that. So it's not infinite, but it can be integer multiples larger. Fractional reserve banking also introduces the risk of a collapse in supply. Fractional reserve banks are subject to runs if the perceived value of the loans declines. Now, these money control problems are not new, not at all new. I think everybody here was alive during 2008, 2009, when we got a chance to see some of those problems. The current system is admittedly imperfect in this, but at least it's taken a variety of steps. It has prudential regulation, deposit insurance, and an elastic currency supply. That is, the Fed can increase the amount of reserves outstanding to reduce these risks. Not obvious that any of this is feasible under a cryptocurrency to me. The government may have some ability to supply prudential regulation of domestic entities, but to the extent you're going to tell me the blockchain is international and beyond anybody's control, then it's beyond anything the supervisors could do. Domestic government's unlikely to guarantee deposits in banks it cannot supervise. And anyway, the government, unlike the current setup, can't borrow or create unlimited amounts of money to repay depositors. And an elastic currency refers to the ability to expand the base money to meet increased withdrawals. That's something the Fed did to a very, very large degree in 2008, 2009. Theoretically, the cryptocurrency code could be changed to expand the base, if you're willing to grant me that from earlier. But this has to happen within days, if not hours, if you're having a run on a bank. And I find it unlikely that any sensible governance mechanism for a blockchain that doesn't have a trusted third party is going to be able to make changes like that within days, if not hours. So, conclusion. Cryptocurrency is still a very minor player in the global financial system. There are a variety of necessary conditions that need to be addressed before it could join the big leagues, including valuation issues, consensus method, governance, and there's several others that I haven't raised. Again, these are not new issues in the crypto community, but it's not clear that the proposed solutions would work for critical financial systems. And then finally, if cryptocurrency actually reaches the higher levels of the minor leagues, I think it likely won't work the way many advocates expect. I think the development of fractional reserve banking in crypto is highly likely raising a new set of issues. With that, Thank you. Sure.
We have questions.
Please wait
does
for the,
anybody have questions?
Yeah.
First off, thanks for speaking. I really do appreciate it. Can you talk about more what the Fed is doing? I've seen some other countries that are actually experimenting with their own kind of government-run crypto. I mean, Dubai and UAE and Saudi are doing it. I've seen it in kind of Russian sphere of influence too in some of my travels. But are you guys actually experimenting with a skunkworks of your own crypto, or kind of aligning with it, or having it align with you, or kind of walk through whatever you're experimenting with?
Okay. So there's been some discussion about what some people would refer to as digital central bank currency. I think the conclusion is that that would probably not be done on a blockchain if it was going to happen. With the issue for a central bank doing that is it's going to be it's going to change the financial system in ways it can't easily predict and may not be able to control. And those changes might be entirely good, but there might be some bad ones in there as well. And if you're responsible for a multi-trillion-dollar economy, you want to be awfully sure before you do something that might trash that economy. And so this is, again, re-emphasized, this is my personal opinion. My personal opinion is that central banks are going to be later to the party, and the bigger ones are going to be slower to the party. Now, there's a few countries that you mentioned. There is one developed Western country that has been talking pretty seriously about it as well, and that's Sweden. And the deal with Sweden is they've had their peak in the amount of currency outstanding, and it has been collapsing and heading rapidly towards zero. And the government's taking a look at this and saying, okay, that means that everybody is going to soon be dependent upon bank accounts. Because in Sweden, two more things. The merchants don't have to accept paper money, and the banks don't need to either accept deposits of paper money, nor do they need to be willing to provide you with paper money if you want to withdraw from your account. And so there's a very real chance that paper money will leave their economy, and the government was asking, is crypto or some digital central bank currency something we need to do so that for financial inclusion purposes? I'm sure I would have heard if they decided to go ahead. I'm not sure if they made a decision yet on doing that.
Folks, I just want to reiterate, please just keep your questions to what Larry has stated above, or you just amplify on that. We're not asking for him to disclose any information about any other central bank or any other technology that he doesn't know about or doesn't want to comment about. Thank you. Okay. Linda?
I'll try to modulate my question to meet those expectations. In regard to fractional reserve banking, which you did present on and showed that as a strength of the central reserve, is that? A strength and almost inevitability. Okay. The reason I'm bringing it up is I've heard of a structure in which someone can come in, say they have $100,000, they can get a $1 million bond by depositing that $100,000, going through a process, get the bond, then go to another bank and put that bond up for collateral, get half of it, say maybe $500,000 in cash. The bank holds the bond, and then they default. But both Bank A and B are happy. One has $100,000 it didn't have to start with. The other has a $1 million bond that it didn't have previously, and someone has $400,000 of newly minted money. Can you speak to that process and its potential legality or illegality?
So the bank that gave, if it was a bond with a current market value of $1 million, and the bank that gave it is not happy. They got their $100,000 deposit, but they gave away something that was worth $1 million, so they've got a $900,000 loss.
Yes.
Yes, it's a real loss. What could have happened was, well, I'd be speculating. What could have happened was that the first bank kept title to the. We can talk afterwards. There's what are called repurchase transactions and rehypothecation of collateral that doesn't quite work the way that you're talking about. You don't get to borrow more than you put in initially, but where you can take a bond, buy a bond for a certain amount of money, and then rehypothecate it out and get almost all that money back. And those can create problems if the party that ultimately is holding the bond can't pay when the time comes. Then there's a chain of problems. And that is a concern that bank supervisors have had for a while.
I was just going to piggyback off that. I was going to say, like, that $1 million that needs to be paid back is in the fractional reserve system has to be paid back to the central bank. So they owe that money, right? So it doesn't just go. The issue I think she's trying to bring up is there's a limited supply of like Bitcoin. There's like 21 million. So you can't do fractional reserve on the current system. You'd have to create like a side chain or something. So like a fractional reserve IOU or something like that. And that's what I think a lot of people who have core Bitcoin values are like kind of afraid of, is like loaning out money, which is like musical chairs, which can't be paid back because, you know, there's always going to be something missing from. But I think that's
yes. A fractional reserve bank is counting on the fact that on any given day, most of the money is still going to be there at the end of the day. And so what it can do is it says, you give me 100 Bitcoin, and I'm going to loan out maybe 70 Bitcoin. I'll keep 30 in case, you know, you decide to withdraw some money. But the other 70 will be out and being held in a loan where somebody else has promised that they're going to repay it. And you and the bank are taking the risk that somebody won't repay the loan. And banks do fail for that reason. But if the bank is prudent and its owners have invested sufficient equity so that they have a good reason to be prudent, then odds are the loan is going to be repaid with interest, and so the bank is going to keep some of that interest to cover its costs and its profit, but it's also going to give some of it to you in return to make it give you a greater incentive to make the deposit in the first place. And that's kind of how banks work now, and I'm kind of like, I don't see why they are not going to work the same way. And if enough people are at the same bank, the stuff that might otherwise have to go on the blockchain doesn't have to go because they become on-us items. If I make a payment to you and you and I both have the same bank, then the bank just takes it out of my account, puts it in your account, and the bank never has to do anything on the blockchain.
First off, just wanted to thank you for coming. Do you have any thoughts on seeing a use for eCash in something like negative interest rates, like Sweden has done, kind of?
There certainly are well, first of all, there are negative interest rates in various countries around the world. So far, that does not apply generally to retail customers. What it is the bank is holding reserves at the central bank. It's basically holding some money at the central bank. And most of these banks, in times in the past, they would pay, central bank would pay positive interest. They'd say, you hold it with us, we'll pay you 3% interest. Now they say, no, we're going to charge you not 3% interest, but we'll charge you 1% interest for holding it with us. As a way of driving down interest rates and encouraging more spending. And an important piece of this is, while the amount of reserves held by any individual bank is under that bank's control, the amount of reserves held in the total banking system is fixed by the central bank. The banking system doesn't have any control over that. So basically, what the Sweden central bank, what the European Central Bank is saying is hey, you guys, stop holding your money as just reserves and start lending it out. Get the economy going. Now, there are people who say an advantage of if we got rid of the paper currency, because it's very hard, it's not impossible, but it's very hard to charge negative interest rates on paper currency. They say, if we get rid of the paper currency and it's all electronic, then we can do just like we do with the commercial banks, and we can say any money you have on deposit with us, you're going to pay us 1% per year as an incentive to pay interest. And there are economists who support that. I personally, very much this is my personal opinion, I think it would be a very difficult sell to our Congress to say, hey, we should go to digital currencies because that'll allow us to charge people interest, and that will put us in a better position to take away their privacy so we can track whatever bad things they're doing. That might happen, but I see that as a really difficult sell in Congress.
Hi, so thank you for speaking. So going back to your argument about, so you said something about cryptocurrencies can't be costless, and that would be a downside. And so I'm kind of wondering what your definition of costless is, because there are cryptocurrencies that on the transactional fee can be costless. You can have zero transaction fees, and the miners or the validators are then paid in inflation. So I just kind of wanted to get your thoughts on that.
That's, you pay one way or another. You pay with inflation or you pay with outright fees. That's all, and so I'm not distinguishing between those two. Somehow they have to be compensated, and in some sense at the end of the day that's going to come out of the people holding and using. Absolutely, yes. The thing is, for a blockchain, the fees have to be sufficiently high so that it doesn't pay for the people with computing power to attack it. You have to pay for security from the other ones, but it's a different setup. Yeah.
So during your speech, you mentioned that you mentioned Rome. Well, one of the reasons Rome fell was because of continually inflating currency, and because of that inflation, people couldn't afford things. People were bringing wheelbarrows to pay for bread or whatever the case may be. So doesn't Bitcoin and cryptocurrency solve that problem by its nature just being deflationary?
So part of it is I don't think the limits, like I said, were quite as strict as you may think, and the potential for other cryptocurrencies to come along if Bitcoin became too deflationary would arise as well. It does impose some limits on what can be done. That's an argument you can make for it. On the other hand, if I'm a legislature thinking about this is going to impose some limits on what we can do, I'm not necessarily going to be all that happy about it. And you know, certainly we've seen in China that it's possible if the government decides that this is not in our interest that it doesn't happen. So
Similar vein.
Yeah, this is the last question.
Uh-oh. In the similar vein, conceivably, if crypto can become less volatile, could modern economies revert back to an asset standard?
Ooh, you mean could they switch back to like a gold standard?
An asset-backed standard.
An asset-backed standard?
Asset being crypto or gold or, yeah.
Could it happen? Yes. And I mean, going back to the earlier question, if governments are sufficiently reckless in any currency, if the government is sufficiently reckless, it will be replaced. We've seen that with dollarization in South America and other parts around the world.
Is government a necessary part of that equation?
I'm a good enough economist to know that you don't say something can never, ever happen. But that saying it,
The assumption
but I
is
find
that-
it improbable, absent a major mistake by governments, just because of the huge investment.
We see governments making huge mistakes all over the world, Venezuela being no exception. If government controls the money only for one purpose, to reduce or eliminate counterfeiting, and we've achieved or have been able to resolve that need with math or with crypto, is government really a necessary component of that equation? Theoretically.
Okay, so I'm going to go back to what I was saying about fractional reserve banking. To the extent that they arise and they become an important part, people, maybe people in the crypto community are willing to suffer some losses to build things up. But people in the broader community are going to expect that the government's going to be looking out for their interests and provide some protection, and a protection that can't be provided. And here, I can speak from experience. There were state deposit insurance systems for banks where the state said, we're setting up this private one, and it's private, and that should protect you. This is the Ohio Guarantee Fund, but the state is making no promises with regards to this. And then some of the banks started to fail. The pressure came on their elected representatives, and all of a sudden the state said, actually, I suppose we really do have to back those deposits. And so the notion that you're going to be able to run this system without any government involvement, it's not an impossibility, but just what I've observed with the financial system is it's going to be awfully difficult. I think I'll leave it at that.
Okay, let's thank Mr. Wall for appearing here and talking before the group. Thank you.